Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Boston Pizza Royalties stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Boston Pizza is a restaurant chain in Canada, the United States, and Mexico. A majority of their locations are in Canada. The company is headquartered in Richmond, British Columbia, Canada, and was founded in 1964. It went public in 2015 and currently trades on the TSX and the Pink Sheets. There are about 400 franchise locations with over $1 billion of sales. The revenue the shareholders are entitled to is the 4% royalty each franchise pays. Let's get started with the model. This is a micro-cap company, 279 million market cap. They're trading at $12.96 a share, and they have 22 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see their free cash flow is pretty consistent. It dropped a lot in the trailing 12 months due to COVID and lower sales. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that's positive every year, except in the trailing 12 months it was negative 15 million. Revenue is the sales for the company. That's also pretty consistent, dropping in 2020. This is the company's income statement. The top line is the revenue, the sales. As I said earlier, the revenue is the royalty payments, not the food and beverage sales from the individual restaurants. Then below that is operating expenses. Example is marketing and depreciation. Then below that is operating income. And they do have positive operating income since they have such low expenses. Then below that is the interest they pay on their debt. They paid the least interest in the trailing 12 months at only $5 million. It peaked in 2017 at $7 million. Below that is other income and expenses. And that's why they have negative net income in 2020, is because of this other income and expenses of negative $37 million. But they did have positive operating income, which is the most important thing when you look at the income statement. So the bottom line of the income statement is their net income, which was negative in 2020, positive in the prior years. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So you can see they're generating positive cash flow every year, even during COVID. And they don't have any capital expenditures because they don't have property, plant, and equipment. All they do is collect the royalty payments from their franchisees. The franchisees pay for all the costs in opening the stores. So they have positive free cash flow each year. It was 36 million from 2017 to 2019. It dropped to 24 million in the trailing 12 months. They don't seem to use much debt or equity to run their business. They're doing it with mainly free cash flows. Let's look at the capital structure. 247 million of equity, 92 million of debt. They're 73% equity, 27% debt. And their WACC is 13.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 465 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $371 million. We divide that by 22 million shares. And we get a calculated stock price of $17. They're trading at $13, so they're trading at a 25% discount. It's a buy according to the model. Simply Wall Street values the company at $9.23, so they're saying the stock is overvalued. They're saying it's a sell. The stock peaked around $24 4 years ago, but it dropped a lot when COVID hit. They did cut their dividend, but in the third quarter of 2020, they brought back their dividend payment and the stock more than doubled. It was as low as $5.30 at one point. Now it's up to close to $13. They receive royalty payments from their franchisees each month, so they can pay us, the investor, a monthly dividend, which is nice. They're up to 7 cents a share, and their dividend yield is 6%. If you bought the stock a few months ago at $6, your dividend yield would be 12%. That's a pretty amazing dividend. But if you buy it right now, it's still a nice dividend yield at 6%. And if the company has excess cash flow at the end of the year, they pay a special dividend. That special dividend payment in December was 27 cents. We can't look at the payout ratio since they had negative net income, but they pay out 71% of their free cash flow. They're retaining 29% for other expenses. You can see they were paying a 12-cent dividend for a while, so I think there's a decent chance they'll bring back that 12-cent dividend. And this company pays a 6% dividend, which is higher than the top 25% of the market, which pays a 4.8% dividend. And their industry pays a 3.2% dividend. But for some reason, analysts are forecasting them to have no dividend payment in the next 3 years. This company is Canada's #1 casual dining brand at almost 400 locations. The next biggest is 212. The average sales per location was growing from 2010 to 2015, but it's been slipping a little bit. It's been coming down. The total number of stores has grown from 2010, but it's pretty steady from 2017. They have a pretty high beta, 1.86, so the stock moves almost 2 times the market. The stock has gone up 116% in the past 52 weeks, while the S&P 500 went up 62%. The 52-week low was 534, the high was 14. And the stock is trading above its 50-day and 200-day moving average. About 60,000 shares are traded on this stock each day. Almost all the shares outstanding are on float. 1.26% of the shares are held by institutions, and less than 0.5% of the shares are shorted. If you include dividends in the past year, the stock went up over 120%. While the industry went up 78% and the market went up 54%. But in the past 3 years and past 5 years, this stock has really struggled. Analysts are forecasting their earnings to grow 47%, while the industry grows 64% and the market 22%. The forecast on the revenue is for the company to grow 16%, the industry 16.5%, and the market 7%. In the past 5 years, their annual earnings decreased 30%, while their industry increased 3% and the market increased 12%. In the last year, their earnings decreased 57%, while the industry decreased 33% and the market increased 5%. Obviously, restaurant brands really struggled in the past year. If you invested $10,000 into this company 10 years ago, you'd be at about $11,000 today. That's including dividend payments. That's about a 1% annual return. The biggest shareholders are UBS, FMR, BlackRock, Dimensional Fund, and last is Jordan Holm, president of the company. Let's look at their financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Price of sales is stock price over sales per share. They're at 7.7. So investors are paying about $8 for $1 revenue. Price to book is stock price over book value per share. They're at 1.1. And the way you calculate book value per share is equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $247 million of equity, negative $37 million of tangible equity, since they have $284 million of intangible assets on their balance sheet. Their return on invested capital is 7.4%, and their WACC is 13.5%. That's a loss of 6 cents every dollar this company invests back into their business. This may change over time because they have a low EBIT due to lower sales from COVID. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments about 7 times. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They can cover their current liabilities more than 3 times. Their current assets are $6 million in cash and $8 million in receivables. The company seems to be well capitalized. They had $24 million of free cash flow, $10 million of working capital, and a $17 million annual dividend payment. So they have about $17 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 14 companies in the same industry as Boston Pizza. And if Boston Pizza has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at the PE because it's negative. They have a much worse than average price to sales ratio. They're doing a lot better on price to book. They have the highest current ratio of all the companies. Negative ROE, but it's a little better than the average. They're a lot lower in debt than the average. And they're the smallest company on this list, but they do pay the highest dividend. So to summarize, I have them trading at a 25% discount, but this stock is really dependent on how many people buy Boston Pizza franchises. It seems like the store has lost about 25% of their business due to COVID. They're not really getting much dine-in sales. A lot of it is delivery or pickup. I think either this year or next year, sales will be really strong. I know a lot of people are itching to get back out and do the things they were doing pre-COVID. I ranked their free cash flow 6 out of 10, their revenue 6 out of 10, and their ratios 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.